Hello, Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, February 22nd, 4:33 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a bearish consolidation, very bearish, under the 200-day moving average. If you check over here on the trend gauge, we've got neutral in for leadership, for market leaders, but the arrow pointing to negative. But across all three time frames and across all five of the major indexes that we track, we're in a bearish phase, meaning we're under the declining 21-day exponential moving average. That's our short-term indicator, below the 50-day medium-term moving average, and below the 200-day long-term moving average. As I'm fond of saying, nothing good happens under the 200-day moving average, although that is where you can get a follow-through day and a re-entry into the market. But when you're breaking to the downside through the 200-day moving average, that's when you want to make sure you get the heck out of the way. So what happened today, a lot like Friday's action, typical volatile bear market action. G6, our growth index composite, down 1.7%. S&P down 1%. NASDAQ 100 down 1%. Dow Jones down 1.4. Mid caps down 1.4. Russell 2000 small caps down 1.5. Diversified worldwide 60/40 stock bond portfolio down 0.8%. In-house, we sold our last position that we had. We were down 0.07% on the day, now in 100% cash. Let's take a look at some charts. Let's take a look at the tail of the tape for some details on the market. But first, let's take a look at the team here at Revere. Participating in uptrends, protecting capital in downtrends. That's the mantra that we manage investment portfolios by. And if you're interested in an approach that follows this common sense trend following approach, give us a shout. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. So tail of the tape, and let's take a look at the type of market that we're in. So one of the most difficult skills to master as you attempt to follow the trend is the determination of when should I be buying strength and when should I be selling strength. Excuse me. So bear markets and harsh pullbacks and generally consolidations, when you're working off overbought conditions, are the times that you do not want to be buying strength in the market. You want to be selling into strength. And if you're even tempted to buy, like you can be right now, you better be buying on weakness. Let's take a look at a 5-minute chart of the S&P 500 here, and you can see this is showing Friday. Let's go to the SPY, actually, so we can see this a little clearer. Look at how, why are we only showing 2 days here? Anyway, there we go. So look at the pattern. Friday, weak open, a little bit of a rally in the first half hour, sustained selling to early afternoon, a sharp rally. These sharp rallies, this is the complete opposite of what you see in a strong market that's pulling back. A strong market will work its way up, 2 steps up, 1 step back, then all of a sudden you'll have a harsh pullback that gives up 2, 3, 4 or more days of gains. That's in a bull market, though. In a bear market, you get just the opposite. You tend to trickle to the downside, and then you have sharp rallies. Could be intraday, could be multiple days. But as long as we're under the 200-day moving average, our studies tell us that that is where risk really picks up. Every one of the 12 bear markets underneath started with a weekly close below the 200-day moving average. Every one of the 12 bear markets where we lost 20% or more going back to 1970 started with a weekly close below the 200-day moving average. Now, not every one of them led to a full bull, but or full bear, I'm sorry, but the average drawdown was, let me dig up my stats here real quick. So here are our bear stats. The average of the 12 dropping 33.5%. Right now we're down about 11% on the S&P 500 from the highs, which is very typical. Normally off of the high, you drop right at 11%. Off the high, we were down about 9% off the high by the time we got that close this time. And then if you exit and get back in with a weekly close back above the 200-day moving average, on average, you're getting in 11.3% lower than where you exited, and you're saving 23% on average of the pain from where you exited to the very bottom. So this is why we get the heck out of the way during bear markets. These are not made up numbers. These are the highs and lows. I've got the dates here. You can pause it right here. Do some investigation yourself if you want to check it out. But some real harsh sell-offs can occur once you get in a bear market. Once you get a weekly close below the 200-day moving average. We've now gotten 3 of them out of the last 4 weeks. So here's your intraday. This is just trudging, trending, slower, harsh rally early afternoon. Same thing today. We had a gap down, some buying over the first half an hour, and then just little by little dripping lower. This is just selling algorithms getting out of stocks. And then Biden talked about Russia around 2 o'clock. We had a sharp rally up and then faded into the close, almost a virtual pattern of Friday. And this is typical bear market action. And basically, it's a stay away market. Let's go to the tail of the tape here and let's talk about the high level view, and then we drill down. So headwinds going on, the market's facing right now: strong dollar, inflation, Fed tapering their balance sheet, rising interest rates, and of course, Russia and Ukraine. Put call elevated from a sentiment standpoint at 1.04. The VIX very high at 28.9. It was up 4% today. The fear and greed index at 33. These can go a lot lower. These are some secondary sentiment gauges that we watch. For example, if we would get a harsh shakeout, we might see the VIX spike near 40. We might see the put call go up to about 1.5. We might see fear and greed drop intraday. That might tell us that it's a capitulation selling, and maybe we might be able to get a good entry in the market. But our bull case was when the S&P reclaimed the 200-day moving average and started a follow-through day, but that failed on 217. So we're working under our bear case scenario right now, S&P 500 under the 200-day moving average. So drilling down into summary of today. Over the weekend, Russia invaded Ukraine. This morning, Germany suspended the Nord Stream 2 pipeline. So they've also shut down half of their nuclear reactors. So their costs for energy are going to go through the roof. And then Biden announced some sanctions, the first tranche of sanctions today. So coming into the day, what I was watching, 2 things. Would the S&P 500 test its overhead 200-day moving average? We got really not enough strength today to even do a test. The other thing was what would happen if the S&P started dropping and we tested the January lows. We did test it and it held. Let's go to a 60-minute chart on the S&P 500 now, and you can see here's the spike low in January, the January 24th is the date. Then we consolidated for 4 days. Then we had this little attempted rally on a breakout, 3-4 day consolidation, tried to move up again, epic fail. This is when the Fed, then we had our pullback, a gap up. This is where the Fed minutes came out, initial strong reaction, but now the last 3 trading days since then, all we've seen is a series of lower highs and lower lows, and that, folks, is the definition of a downtrend: lower highs and lower lows. So one of the first things we'll be looking for is to make a higher low on multiple time frames, some of the shorter time frames as we go across. Now, this is the 3rd straight day down in the S&P. If we go back to a daily chart here, after the Fed announcement, 3rd straight close below the 200-day moving average, and again, lower highs, lower lows. A little bit of a pop after hours here, but right now we're in a downtrend. So as I mentioned, looking on the 60-minute chart, we tested the lows of this range today, if you exclude the shakeout day on the 24th, we then had 4 days where the lows were around 4,300, 4,290 to 4,300. We undercut it and bounced today. So if you want to take anything good away from today, that's the one thing that you can take away. Tested and bounced against the January lows. So some notes overnight, over the weekend, 3-day weekend, Friday, Sunday night, Monday night, the futures were open, but the markets obviously closed for President's Day on Monday. Extreme volume down 2.2% between Sunday night and Monday night, all the way to near flat by the open. And then you see what the behavior was, what we had intraday. The NASDAQ 100 during the Friday night and Monday night action undercut its 124 low. Bottom line, market is acting like a casino, not a market. Violent rallies. In 15 minutes, you can be up or down 1%. Stocks even more volatile than that, especially growth stocks. So this is a market that we want to avoid below the 200-day moving average. We know that's where risk picks up, and that's where these volatile days tend to pick up also. This is also the time when you'll see pie charts stay on all in all the time. People will be saying, well, what if you missed the 10 best days in the market? Because a lot of those occur under the 200-day moving average, but the problem is they're sandwiched with terrible days that they just don't mention in their stats. So portfolio changes today. We sold our last position in our GU as we had a big negative reversal across the board on oil stocks, and our stop was hit today. Strength today, commodities, silver, gold, oil, nat gas. Oils and gold stocks and base metals started strong but faded all throughout the day, and weak from the outset and all throughout the day were home builders and retail stocks. So let's get down to the key levels here. You can see we've been over these multiple times as we just keep breaking these ranges lower and lower. Prior close was 43.49, and my comment for Friday, typical volatile bear market action, pretty much the same as today. We closed at 43.05. This is an undercut of the 222. It was on 222 today. We undercut the shakeout range from 124 to 128, undercut and reclaimed it. As I said, if you have any positive takeaway, it's that held today. We'll see. So the next level down, 42.23, that was the low of the 124 shakeout day. Let's go back to the indices and finish those up. Here's the NASDAQ 100. On this chart, there's no undercut. We spared it by 20 cents, but the futures, the NASDAQ 100 futures, did undercut Monday night before bouncing. So same situation. We're under all the moving averages. Very bearish action, especially bad relative strength on the NASDAQ 100 relative to the S&P 500. Dow Jones Industrial Average, same thing. Actually, the fourth straight down day for the Dow below the 200-day moving average. Some of you people will be tempted to be buying, catching falling knives. We'll wait for some signals, either a capitulation sell-off or a follow-through day with some good action by stocks before we re-enter the market. Here's the mid-caps under all the moving averages. 50-day has now sliced through the 200-day. Small caps under all moving averages, and they're just, if they could flip this on its head, this would be an ideal bull market. But we can't just flip it on its head. We're under all the declining moving averages across the board on small caps. So let's talk, I mentioned one of the hardest things to do to determine is when to buy strength, and there's these harsh rallies are a very strong temptation, but especially below the 200-day moving average, we're going to avoid it. And then all of a sudden, one of these times, we got another distribution day today, by the way. So I think that's 6 on the NASDAQ and 5 on the S&P since the follow-through day failed. And we had the follow-through day on 124. So my advice, and you can do exactly what you want to do, but is to, in most instances, stay away from these sharp rallies in growth stocks. May get some bargains and some things that have been holding up, like commodities. Let's take a look at a CF. This is a fertilizer stock holding the 21-day moving average. Most of our 2121 still acting well, just a couple that pierced it today. So But those aren't, a lot of those are not growth stocks in there. It's not what it would look like if we were in a true bull market. So let's take a look at a couple of names. Here's Macy's. Very typical. Macy's is a low PE stock, PE of 5. Great numbers, 206%. Earnings increase, 28%. Sales increase. Gapped up, big volume. Tried to break above this 28 area, this prior resistance. Epic fail. Broke below the moving averages near the close of the day. This is the type of action that you see on breakouts in this type of a market. Now let's take a look tomorrow at how PANW acts, up 6% back above $500, the $500 level, but below the declining 21-day moving average. Let's see if this gap up gets sold tomorrow. So this is, if you're looking for green shoots, you look for things that for change of character and things, a change of character would be something that normally we're expecting sell-offs in these gap ups. Suppose they start continuing to the upside. That would be an example of a change of character to the upside that we'd be looking for to get us even a little bit bullish on the market. Last Tuesday when I did a video, we had just had a gap above the 21-day moving average, and I was mentioned to keep an eye on Tesla, because this could lead us higher. But look how the 21 continues to just be a brick wall. Can't get above it now. Tesla closing below its 200-day moving average today. And then I was also watching for NVDA on their earnings report last week, which by all intents and purposes was a fantastic earnings report, but it was rewarded with a down 8% day on the day and 2 more lower closes since then. NVIDIA sitting on its 200-day moving average. Sometimes these are good entries at the 200-day or below and then back above the 200-day in big titans of industry, so to speak, in these type of stocks, but that's not usually a game that we play. So let's wrap it up. As always, any feedback, I welcome it. You can email me, don@revereasset.com, or you can call 855-REAL-WEALTH. So what we're looking for tomorrow is to see on the upside a test of the some strength, and let's see how far we are below the 200, 3.4% below the 200-day moving average now. So first, let's see on the upside if we would get above the declining 8 EMA, and then the 21 is going to break through the 200-day tomorrow. Let's see if we get there, and then finally, if we test or get back above the 200-day moving average, and then does that coincide? Right now, we're in a correction. So it's day 0. The first thing we needed to see is a single close above the recent low, and then normally we count 4 days to look for our follow-through day with some strength. Maybe the Fed relents a little bit. Maybe we get actually some weak economic data that has them back off a little bit, which would be a contrary bullish signal. We're prepared. We've got our bull case and our bear case. As always, but right now we're firmly in the bearish camp, and I should say the action is in the bearish camp as we interpret it. So wrapping up Tuesday, February 22nd, 2022, all deuces today. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.